Hi traders, in this video we'll be talking about inducement. What is inducement, how to avoid inducement, and how to trade inducement. As an ICT trader, inducement is one concept that you need to understand in order to avoid being stopped out unnecessarily in the market. So now let's get down to what inducement is and how to avoid and also trade inducement. Now, inducement is simply a form of liquidity that occurs as a fake breakout or a trap for retail traders. Simply put, is a form of liquidity that occurs as a fake breakout or a trap for retail traders. Now, what does that mean? Now, let's say you're in a bullish trade and the market is going, higher high, is a higher low, higher high. Now you're expecting a higher low, right? And so what now happens is then you see something like this, price begin to do something like a range like this, and all of a sudden price goes down like this. So now traders who trade a breakout, there's some traders who trade breakouts, so they'll feel like this is a breakout zone. They wait for price to retrace into this point and for them to sell, right? They wait for price to retrace here, then they're looking for sell, only for them to get stopped out when price continues the trend, continues the trend, continues the trend. So what happened here was that they were induced here. This was inducement here. This was inducement, and market did that to take out retail traders, those trading breakouts, expecting to sell from this point. Those who were expecting to sell, hoping to sell from this point, right? They were hoping to sell from this point, and what happened? Price took them out. So that's inducement. Is a form of liquidity that occurs as a form of breakout or a trap for retail traders. And we all know that as ICT traders, we all understand market structure. Now, this movement, is there a change of structure here? No, this is simply a bullish trend. But if you're not aware, you think this is a change of structure to the downside. You want to sell from here. So trading was actually frustrating for me when I didn't understand this inducement concept. But now I understood it. It has been very easy. So I just literally relax and wait patiently to avoid inducement, and I continue the trade. So now let's talk about how to avoid inducement and also how to trade inducement. Alright, so how to avoid inducement and to trade it. Number one, identify the market direction. And number two, wait for the PDRA. There's the premium and discount zone. You wait for, if it's an uptrend, you wait for price to come down to the discount PDRA, the discount zone, which is 50%, from 50% below. And also if it's an uptrend, you wait for price to trade to the premium zone, which is also 50% above. Then lastly, the third thing, you wait for the fair value gap or OB, that's the order block mitigation. That's price should mitigate the fair value gap or the order block, then you take your trade. So now with this diagram here, now first of all, I want to identify the overall trend. This is an uptrend, right? This is an uptrend, and we know that in an uptrend, market creates higher high, higher low, higher high, and we're expecting a higher low, but this higher low didn't come down to the PDRA, and PDRA is like from a 50%. So if we bring our Fibonacci to this, so we want anything down here, anything from this 50% below is our discount PDRA. So now waiting for price to trade into this point is where we are going to take our trade, right? Because why the market is doing like this, why the market is ranging like this at this if you go to the lower time frame, it might be a huge range, right? Now it's planning to create inducement, and the moment it takes the inducement, it will trade into another block. It will trade into another block or a fair value gap. Any of these two. This is where you want to take your trade from. So you want to take your trade from this point, either from the order block, right? You just put your stop loss below the previous low, and you are targeting this high. Boom, that is just how you should take your trade. First of all, you identify the trend of the market. Now you wait for price to trade into this is a bullish trend. So you wait for price to trade into the discount zone, which is 50% of a Fibonacci, below 50% of a Fibonacci. It's advised that you wait for price to come down to like 618, even to 70. Okay, let's see. So you see, you wait for price to come down to the 618, 78.60. You just wait for price to come down, and while it's on this discount zone, you're also marking your fair value gap and order block, because that's where you are taking your trade from. The aim is also to liquidate, to take out breakout traders, people who want to, it's just like a form of trap. Inducement is a form of trap to just manipulate traders and continue the direction. So that's why it's very important you know the market direction first, and whenever you see something like this happen, you just know that the market wants to trap retail traders. Also, on a bearish trend, we identify the market structure, we identify the market direction. You can see it's a downward trend, a high, a lower high, a lower low, lower high, lower low, and it started ranging. We all know that the market is going down, the market is going to sell. So whatever is happening here, we know that what we are expecting is inducement. So, and now we wait for price. Price is going to induce, market is going to induce this range here. It's going to induce, and it's giving a fake breakout for people who wants to buy. So some traders might see this as an opportunity to buy, right? But we understand that the overall market direction is bearish. So now we wait for price to trade into the premium zone, right, which is over 50% and above, and also there is a fair value gap here, a fair value gap and order block. So when price has traded into our premium zone, we also wait for a mitigation of the order block or fair value gap. We also wait for the mitigation of the order block or fair value gap before we can take this trade, right? So when price induce into the premium zone, we wait for it to mitigate, to also go up, because there's definitely a fair value gap or order block there. So we wait for price to mitigate it very well, to be sure that there is no more, to be sure it has balanced the price action and it's going to drop. So you just put your stop loss above. So you put your stop loss above the previous high, and then you target this place. Easy like that. So let's go to the chart and let's see what we have there. So on the chart, I already mark out this inducement here. Inducement is actually everywhere in the chart. It's everywhere, but this is actually the 4-hour time frame, right? If you go to the smaller time frame, the inducement everywhere. So already this is a downtrend, right? This is a downtrend. We can see a high, a low, a high, a low, a high, a low, a high, and we are expecting further low, right? And now you see what price did here. Market price was actually coming down, right? And it has not gotten to, so from here, this is also a high. This point now is a high, and this is a low, right? This is a low, this is a high, this is a low. But this high has not gotten into the premium, into the PDRA, that's the premium zone. So if you take your sell from here, you will get stopped out, which is inducement. If we bring our Fibonacci to put from here to this point now, you see that this price action didn't get into the 50% Fibonacci zone. You can see it didn't get into the 50% before dropping. So if you take this trade now, if you take this trade here, only for you to be shocked that market has stopped you, market will just stop you, and before you know, continue the trade. So now we are waiting for price to trade into the 50%, above 50%, which is the premium zone, right? And also into the fair value gap and order block. So there is also a fair value gap here. This is a huge fair value gap, but the strength of it is waiting for it to get into the order block. So when price got to this order block, we can sell from here. can just sell from here, and our stop loss below this previous, below the order block and target here. Nice, nice. So going forward, I saw another one. So this is price coming down, a high, a low, a higher high, a lower high, a lower low, and look at what price has been doing, ranging. Before you know it, it just traded into this fair value gap and order block and started dropping. So that is just how, that's what inducement is. Some breakout traders might want to start buying. So the moment they saw this when they saw price creating movement like this, right, like this, now this is a breakout where this inducement occurs. So they saw this breakout, price move, so they'll be waiting for retracement, and with even this candle, some persons might have placed their buy trade expecting this market to start buying, and you can see initially it was buying, only for them to also get stopped out here. They also got stopped out, and the price continued the market direction. So the first thing is to know your market direction. We can see that this is a downtrend. So whatever the market is doing, we understand that this is not yet a change of character. This is not yet a change of structure. The market is still bearish. So we just wait for price to trade into our PDRA. For a sell trend is actually the premium zone, right? And it should mitigate a fair value gap or order block. So the moment it has mitigated this, then we can just sell. So from here we could take our sell trade. The order block is actually the stronger is more of a stronger confluence. It's more of a stronger zone to take your trade from. So you can see, and price will just deliver nicely. I can go on and on because I actually marked them on my chart. So you can see here. You can see here how the price, it was also on a downtrend. So whatever market was doing here, it's none of my business. It's none of our business, because we know that there is a trap. And you can see these are liquidity. Liquidity is simply where money lies, right? So money is here. We know that price is going to continue the direction. So we just chill. And the moment price trade into the fair value gap, we want to take our trade. We want to sell because we know this is inducement. So understanding the market structure, the direction of the market, will help you avoid inducement, and also waiting for price to trade into the PD array will help you avoid it. And taking your trade is to wait for it to mitigate the fair value gap or the order block. Thank you so much, guys, for watching. If you found this video helpful, kindly like, comment, and also subscribe. See you in the next video.